One of the most common questions that we've been asked is around performance. Obviously, members want to have some understanding of how this fund might shape up against the current growth fund or growth option. Again, I think we've got a slide to help shed some light on this. Toby, you want to work through it?
I mean, if you have a look at the slide, one caveat needs to be given, which is that for the earlier data, we've had to report the benchmark for the index for the fund, because the fund's only been around for a few years. So some of that earlier data is benchmark being compared to the existing growth fund. But you'll notice that over the long time, sometimes one fund does better than the other, but generally, on average, we'd kind of expect them to perform at about the same level because they've got a similar mix in terms of growth and defensive assets in them.
Okay, so you know, sometimes they'll be quite similar in terms of the return. Sometimes there'll be a difference, but you'd expect over time for it to even out somewhat.
That's right.
And I suppose another caveat here is, you know, that past returns and, you know, no indication of future returns.
That's right.
So, you know, looking at this construction of what's happened over the last 9 years doesn't mean that that's setting up a pattern for what might happen over the next 9 years.
Exactly.
Yeah, I think you had that on your graph as well. Obviously, the fund wasn't in existence, so a lot of the data that had to be given in terms of historical data has had to come from benchmark data.
Yeah, okay. Toby, one of the questions that came in was around the unit price. Someone asking what will the unit price be for growth lower carbon on day one, which, you know, I thought it might be worth just to take a minute to explain the unit pricing and how that works.
Certainly. So when the new product launches, it will have a unit price of $1. So, you know, you'll buy into it for $1. Think this is somewhat similar to a share price. As the fund starts earning returns, that will hopefully grow. You know, will go up and down as the returns, depending on whether they're positive or negative. One thing to keep in mind is that obviously it will take a little bit of time for money to flow into the fund, and so we might see for the first day or two that price doesn't move because people's money is sitting there waiting to get invested.
Okay.
Obviously, if you have a glance at there, you'll see that there's quite a range of different securities in the conventional growth option, and when you look at the lower carbon fund, there's really just the two products: the global bonds and the global equities ex fossil fuels. In terms of the investment in equities, with the conventional growth fund, we hedge half of that risk. So that would mean that we enter into forward positions to lock in what the exchange rate's going to do. Now, that can be a mixed blessing. Sometimes the exchange rate moves in your favour, and sometimes it moves against you. But we get rid of half of that risk for the equity component in the conventional growth fund. With the growth lower carbon, there isn't any hedging going on with the equity component. Again, that could work better, could work worse, depending on which way the exchange rate moves. The other sort of key difference between them is in terms of the equity component. For the conventional growth fund, it's split between, the equities are split between two products. One of them is is straight up global equities, and the other one is the sustainable fund, which the sustainable fund is passively managed, so it just tries to follow an index, whereas the other portion of the equities is actively managed, so it's trying to beat the index. Whereas in the case of the growth lower carbon, all of that equity exposure is passive. And as a result, when you come down to the final fee structure, it's a slightly cheaper option, the lower carbon.
So, you know, all of these things are differences that the growth option and growth lower carbon are you know, quite different in their makeup and have different characteristics that will affect performance, not just the absence of fossil fuel.
That's correct. So you're going to be exposed to the the difference in the assets that have been allocated in the equities, you're going to be exposed to more exchange rate risk, which again could go either way, and you're going to have that difference in the active and passive. And as noted, you're not going to have investments in infrastructure or investments in property, investments in high yield bonds.
Yeah.
And I think once you do that, you're obviously going to have a much more volatile product. So we see long-term outcome, you're probably broadly similar outcomes in terms of the growth products, but for growth lower carbon, it's likely to have a much more volatile time. And that's mainly due to, taking out those diversifying asset classes around infrastructure and property, like you're saying. It also doesn't have that New Zealand exposure in terms of New Zealand equities and New Zealand fixed income. So again, that kind of offsets things a little bit. And then also by not having it hedged, the hedged product, for the existing products, you'll generally get that pure exposure to the asset class, whereas if you've got an unhedged product, you're going to be sitting there and currency is going to be a major part of your return. So again, that would all lead to growth lower carbon being a bit more volatile over the short term.
Sure. And that's what we saw when we looked at the past performance, right? There were some years where this did better, there were some years where it did worse, very few where it would be exactly the same.
But overall, you've got 80% growth assets, 20% income assets. So broadly, you would expect over time a similar outcome.
That's correct. And let's reiterate that this global equity, global sustainable ex-fossil fuels is trying to follow the same indices as our existing funds.